Let's say you just inherited a bunch of money or sold a property and you expect to have a whole bunch of money coming in, and you've heard that dollar cost averaging is great, but also that the more time that you have that money in the market is also a great move. There's also an election coming up, making markets very volatile and worldwide events causing ripples in the market. So what is the best way to do it right now? Also, most of you know from my past videos over the past couple weeks that I have a black eye taking an elbow in jiu-jitsu. It's still here. I don't know how long this thing's gonna stay.
It ain't about how hard you hit. It's about how hard you can get hit and keep moving forward.
Thanks, Sylvester. That makes me feel better. Now this video is gonna go over a couple of strategies because believe it or not, there's not one absolute strategy that works for everybody. Depending on your personality and your emotions, there will absolutely be a correct one for you. I'm Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. So for this video, I'm going to be using facts and data because I am an academic, and so I'm not just going to purely be basing this off my own opinions. Because guess what? Sometimes my opinions are wrong, but I have done extensive research on this topic, and I have done private financial coaching with over 250 individuals, and so I've been able to see clear patterns of what works and definitely what doesn't work. To book a session with me, go to ProfessorG.invest@gmail.com, and we can look at your options, your portfolio, and tailor a perfect strategy for you to hit your goal. Okay, here we go. First option is to throw all your money in at once. Let's say you inherit $500,000, you just take all that money, throw it in the S&P 500 today, and you're done with it. From Vanguard, investing all of your money at the same time is advantageous because you'll gain exposure to the markets as soon as possible. Historical market trends indicate the returns of stocks and bonds exceed returns of cash investments and bonds. When markets are going up, putting your money to work right away takes full advantage of market growth. Straight up, the absolute best time for anyone to invest is when the market is at its lowest, at the very, very bottom that it'll ever be. That's the best time to throw all your money in a lump sum. Because if you put all $500,000 in at its absolute lowest and it only goes up from there, boom, you won. The problem is that there's no way of knowing when that actual bottom is. It could just be a bottom for now, and it could keep going lower. We could be waiting for that bottom for years, and it could just slowly keep going up forever. But let's say that then you just pull the trigger and you do throw that lump sum in today, and next week the market drops like 20%. Now your $500,000 is worth $400,000. Not ideal. Now let's look on the flip side and let's look at the pros and cons of dollar cost averaging. Dollar cost average is just to buy at certain intervals with a certain amount of money each time, no matter what the price is. Looking at VU, which is the S&P 500 ETF from Vanguard, the price today is at about $515. Looking at this year, if you bought one time each month, you would have bought at $430 in January, $452 in February, $466 in March, $455 in April, $486 in May, $491 in June, $504 in July, and then $476 in August. Some of those were high and some of those were low, but on average, between 8 buys, the average price was $470, which means that on average, you made about 10% buying throughout the year so far based on today's price. If you would have waited till about midway through the year because you were scared of that recession that everybody was talking about at the beginning, and so you bought in June with a lump sum instead, you would have bought all your shares at $491 in June, which would mean you'd only be up about 5% now, which is half as much. Vanguard says dollar cost averaging may be for you if you want to minimize the downside risk of a huge investment, take advantage of the market's natural volatility by lowering the average price you pay for shares, and avoid feelings of regret if the market takes a downturn after you invest. With dollar cost averaging, if we were to take that same $500,000 inheritance that we got from before, you would pick a set number of months and then just divide that $500,000 by those months. So if we wanted to dollar cost average that $500,000 over 10 months, you would just do $50,000 in every single month for the next 10 months, no matter what the price is. So let's say that you put that $50,000 in January, and then you put that $50,000 in February, and then in March it drops that 20% that I was talking about from before. On paper, yes, that $100,000 that you've put in is now worth a little bit less. It's worth about $80,000 if it dropped 20%. But now that month, you get to buy with that $50,000 at a cheaper price. And so eventually, when this thing averages out and comes back up, you will have bought at that cheaper price, giving you more profit long term. So which one is better? We're gonna get to that in a second, but first, let me introduce the sponsor of this video, Moomoo. I wanted to bring this to your attention because Moomoo is actually gonna give you 20 free stocks to get started on the platform. And another amazing benefit is that they have the highest APY I've ever seen on a cash account at up to 8.1%. Moomoo's great because it has very little to no fees and $0 commissions on trades. I also really like this heat map that breaks things down in a picture to easily see what's happening. Click the link down in my description to get up to 8.1% APY on your cash, and you can get 20 free stocks through this promotion on my channel only. So which is better, to lump sum invest or to dollar cost average? This is where you come in. If you knew that this money was not to be touched for at least another 10 years, but next year the market dropped like a big 40%, would that freak you out? I know for me, if the market dropped in half tomorrow, I would be able to sleep like a baby knowing that I'm not touching it anyways. I'd actually throw any cash reserves that I have right at it because it's down so much, and I'd be able to just keep living life as if nothing happened. If you're at all worried about the week to week or month to month, you should definitely be 100% dollar cost averaging. Even if you are somewhat higher with the risk profile and you are somewhat okay seeing a lot of losses in your portfolio, knowing that it's not actually anything because you're not taking the money out now, psychologically, it just might be better for you to do this hybrid strategy that I'm gonna talk about. Now, generally, markets go up. And when I say markets, I'm not meaning that each individual stock will always come back. Sometimes stocks go down and it's because the business is bad, or it's because the CEO is bad, or because they've made some shift and it's not working out well and other companies are taking over market share. So individual companies can absolutely drop and never come back up. But markets, broad markets, on average and generally do come right back up and continue to hit all-time highs. The ones I'm talking about would be ones like the S&P 500 ETF, VU, or SPLG from State Street, the total US stock market ETF, VTI, any ETF that tracks the NASDAQ 100 like QQQM, and then solid tested dividend funds like SCHD from Schwab or VYM from Vanguard. Looking here at the S&P 500, when you look at it zoomed out like this overall, the trend is up and to the right. Yes, there are some dips in there, but the market recovered and crushed it at all-time highs every single time. Now, there will be market volatility and it will mess with your emotions, especially the election coming up and the worldwide issues that we're seeing right now. These are making the market rise and fall like crazy. So what would I do personally if I got that $500,000 inherited to me? What would I choose? I'd do a hybrid, because I know the stats and I know the data. The S&P 500 has posted positive calendar year returns 73% of the time and negative calendar year returns 27% of the time, with an average calendar year return of 21% over the positive years and negative 13% over the negative years. Knowing this, I'd want to take advantage of the fact that time in the market beats timing the market. By only dollar cost averaging, say $50,000 over that 10 months, what you're really doing, especially at first, is you're putting $50,000 in, but $450,000 is just sitting out there in cash, not being able to work in the market, not being able to get that compound interest started. So I'd go $250,000 or half of it in right now today, no matter what the price is, even at all-time highs. Then I'd do $50,000 per month over the next 5 months, getting to $500,000 total. Again, especially with this election season and through the beginning of 2025 with the rate cuts coming and all this craziness coming to fruition, I foresee some big market volatility and market swings, and I want to get in either way. To see exactly what I'm invested in this most simple 3-fund portfolio out on the market that's crushing it, watch this video now, or watch this one to keep you going strong in your investing journey.